Welcome to our in-depth look at the history of the Federal Reserve Bank, a pivotal institution that has shaped the economic landscape of the United States for more than a century. Throughout this comprehensive analysis, we'll explore the Fed's origins, its structure and functions, and the critical role it has played in steering the economy through times of prosperity and crisis. Along the way, we'll examine some of the most significant successes and failures of the central bank, shedding light on its impact and lessons learned. Economic turmoil in the 19th century. The 19th century was a time of economic turbulence in the United States. There were frequent financial panics and economic recessions, which led to a lack of confidence in the banking system. The U.S. government attempted to address these issues through various measures, including the establishment of a national banking system in 1863, but these efforts were not enough to stabilize the economy. The Panic of 1907. The Panic of 1907 was a major financial crisis that further highlighted the weaknesses of the U.S. banking system. The panic was triggered by the collapse of the Knickerbocker Trust Company, a large New York City bank. This led to a wave of bank runs and a liquidity crisis that threatened to destabilize the entire financial system. The Aldrich Plan. In response to the Panic of 1907, Congress established the National Monetary Commission to study the issue and make recommendations for reform. The commission was chaired by Senator Nelson Aldrich, and its work culminated in the Aldrich Plan, which called for the creation of a central banking system that would oversee the nation's monetary policy. The Federal Reserve Act of 1913. The Aldrich Plan faced significant opposition from both the public and politicians, who were concerned about the concentration of power in the hands of a few bankers. Instead, Congress crafted the Federal Reserve Act, which created a decentralized system of 12 regional Federal Reserve banks, overseen by a board of governors appointed by the president. The Federal Reserve was given the power to regulate the money supply, set interest rates, and act as a lender of last resort to prevent bank runs and financial crises. The Federal Reserve Act was signed into law by President Woodrow Wilson on December 23, 1913, and it remains the basis of the U.S. monetary system to this day. The Board of Governors. The Board of Governors is the central governing body of the Federal Reserve System. It is comprised of 7 members who are appointed by the President of the United States and confirmed by the Senate. The Board of Governors is responsible for setting monetary policy, regulating and supervising banks and other financial institutions, and overseeing the operations of the Federal Reserve Banks. The 12 regional Federal Reserve Banks. The Federal Reserve System is divided into 12 regional districts, each of which has a Federal Reserve Bank. The regional Federal Reserve Banks are responsible for implementing monetary policy, providing financial services to banks and other financial institutions, and conducting research on economic issues. Each regional bank is governed by a board of directors, which is made up of representatives from local banks, businesses, and community organizations. The Federal Open Market Committee, FOMC. The Federal Open Market Committee is the primary policymaking body of the Federal Reserve System. It is comprised of the 7 members of the Board of Governors and 5 of the 12 Federal Reserve Bank presidents, who serve on a rotating basis. The FOMC is responsible for setting the target federal funds rate, which is the interest rate at which banks lend money to each other overnight. Key functions. The Federal Reserve System has several key functions, including 1. Conducting monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates. 2. Regulating and supervising banks and other financial institutions to ensure the safety and soundness of the banking system. 3. Providing financial services to banks and other financial institutions, including maintaining accounts, processing checks, and providing loans. 4. Conducting research on economic issues and disseminating information to the public. Overall, the Federal Reserve System plays a critical role in promoting the stability and growth of the U.S. economy. World War I and the Fed's role. During World War I, the Federal Reserve played a key role in financing the war effort. The Fed expanded the money supply and bought government bonds to fund the war, which helped keep interest rates low and stimulated economic growth. However, this expansion of credit also led to inflation, which became a significant problem in the post-war period. The Roaring Twenties and the Fed's influence. In the 1920s, the U.S. economy experienced a period of rapid growth and prosperity known as the Roaring Twenties. The Federal Reserve played a key role in this expansion by maintaining low interest rates and providing liquidity to the banking system. However, The Fed's policies also contributed to the speculative bubble that formed in the stock market, which ultimately led to the stock market crash of 1929. The Great Depression. The stock market crash of 1929 marked the beginning of the Great Depression, a period of severe economic contraction and high unemployment that lasted throughout the 1930s. The Federal Reserve's response to the crisis was initially slow and ineffective, as it continued to pursue policies that exacerbated the deflationary pressures in the economy. However, the Fed eventually adopted more aggressive policies, such as open market operations and the discount rate, which helped stabilize the financial system and stimulate economic recovery. In 1935, the Federal Reserve Act was amended with the Banking Act of 1935, which gave the Fed additional powers to regulate and supervise banks, and established the Federal Deposit Insurance Corporation, FDIC, to insure bank deposits and prevent bank runs. These reforms helped restore public confidence in the banking system and laid the groundwork for the Fed's future role in promoting financial stability. The Banking Act of 1935. The Banking Act of 1935 marked a major expansion of the Federal Reserve's powers and responsibilities. The act gave the Fed additional authority to regulate and supervise banks, and established the FDIC to insure bank deposits and prevent bank runs. These reforms helped restore public confidence in the banking system and laid the groundwork for the Fed's future role in promoting financial stability. Post-World War II era. In the post-World War II era, the Fed focused on maintaining price stability and promoting economic growth. The Fed adopted a policy of targeting low inflation and maintaining stable interest rates, which helped create a period of sustained economic growth known as the Great Moderation. The Great Inflation. In the 1970s, the U.S. economy experienced a period of high inflation known as the Great Inflation. The Fed's response to the inflation was initially slow and ineffective, as it continued to pursue expansionary monetary policies. However, under the leadership of Paul Volcker, the Fed eventually adopted a more aggressive approach to fighting inflation, which helped bring inflation under control. The Volcker era and the fight against inflation. During the Volcker era in the 1980s, the Fed adopted a policy of tight monetary policy, which helped bring inflation under control but also contributed to a period of economic recession. The Fed's efforts to combat inflation were ultimately successful, and inflation remained low throughout the 1990s and early 2000s. The Greenspan era. During the Greenspan era in the 1990s and early 2000s, the Fed focused on promoting economic growth and stability. The Fed maintained low interest rates and pursued expansionary monetary policies to stimulate economic growth, which contributed to the growth of the housing market and the emergence of the subprime mortgage crisis. The financial crisis of 2008 and the Fed's response. The financial crisis of 2008 marked one of the most significant challenges in the history of the Federal Reserve. The Fed responded by implementing a series of unconventional monetary policy measures, including quantitative easing and the purchase of troubled assets, in an effort to stabilize financial markets and prevent a complete collapse of the financial system. The post-crisis period. In the post-crisis period, the Fed continued to pursue expansionary monetary policies to promote economic growth and stability. The Fed also began to focus more on regulatory and supervisory functions, in an effort to prevent future financial crises. The COVID-19 pandemic and the Fed's actions. The COVID-19 pandemic marked another significant challenge for the Federal Reserve. The Fed responded by implementing a series of aggressive monetary policy measures, including cutting interest rates to near zero, expanding asset purchases, and providing emergency lending facilities to support financial markets and the economy. The Fed's actions have been credited with helping to prevent a complete economic collapse and supporting the recovery. A. Successes. 1. Stabilizing the financial system during the Great Depression by providing emergency loans and promoting economic recovery through monetary policy. 2. Maintaining price stability and promoting economic growth in the post-World War II era, which contributed to a period of sustained economic growth known as the Great Moderation. 3. Successfully fighting inflation during the Volcker era in the 1980s, which helped bring inflation under control and laid the groundwork for the economic expansion of the 1990s and early 2000s. 4. Responding to the financial crisis of 2008 with a series of unconventional monetary policy measures, which helped stabilize financial markets and prevent a complete collapse of the financial system. 5. responding to the COVID-19 pandemic with aggressive monetary policy measures, which have helped support the economy and prevent a complete economic collapse. B. Failures. 1. The Fed's slow and ineffective response to the Great Depression in its early years, which contributed to the severity and duration of the economic downturn. 2. The Fed's role in contributing to the speculative bubble that formed in the housing market in the early 2000s, which ultimately led to the subprime mortgage crisis and the financial crisis of 2008. 3. The Fed's slow and ineffective response to the inflation of the 1970s, which contributed to a period of economic stagnation and high unemployment. 4. The Fed's failure to anticipate and prevent the financial crisis of 2008, which highlighted weaknesses in the regulatory and supervisory functions of the Fed and other government agencies. The future of the Federal Reserve will be shaped by a variety of factors, including economic trends, technological developments, and political and regulatory pressures. Some of the key challenges and opportunities that the Fed will face in the coming years include: 1. Promoting economic growth and stability in a rapidly changing economic environment, characterized by technological disruptions, globalization, and demographic shifts. 2. Ensuring the resilience and stability of the financial system in the face of new and emerging risks, such as cyber threats, climate change, and geopolitical instability. 3. Maintaining the Fed's independence and credibility in a politically charged environment, where the role and scope of government intervention in the economy are increasingly contested. 4. Adapting to new regulatory and supervisory challenges, including the need to address the risks posed by fintech firms and other non-bank financial institutions. 5. Continuing to innovate and evolve in response to new challenges, by exploring new tools and strategies for conducting monetary policy and promoting financial stability. Overall, the future of the Federal Reserve will depend on its ability to adapt to new challenges and opportunities, and to maintain its commitment to promoting the stability and growth of the U.S. economy. In conclusion, the Federal Reserve has played a critical role in shaping the U.S. economy and financial system since its inception in 1913. Over the years, the Fed has faced numerous challenges and opportunities, ranging from economic crises and inflationary pressures to technological disruptions and regulatory reforms. Despite these challenges, the Fed has remained a steadfast institution, committed to promoting the stability and growth of the U.S. economy. Looking to the future, the Fed will continue to play a key role in promoting financial stability and ensuring the long-term prosperity of the United States. Thank you for watching. If you enjoyed this video, please give it a thumbs up and consider subscribing to our channel for more content like this. Don't forget to turn on notifications so you never miss a video. And feel free to leave a comment below with your thoughts or suggestions for future videos. Thanks again for watching, and we'll see you in the next one.